Hello everyone and welcome to your Glassnode video report for week 13, 2022. So we've seen Bitcoin rally this week over the weekend to really come up to about 47,500. So we've seen it break above the consolidation range we've been in for about 2 weeks. And really this is a fairly constructive sign. And we've been talking about this accumulation that's been going on kind of a bit sporadically off and on, but it's still been a net period of accumulation for the last 2 and a bit months. So what we're going to explore here is what are the underlying fundamentals and do we think that Bitcoin is now on the road to recovery? And what are the risks we need to pay attention to moving forward? So as I mentioned, we've seen a strong push above the consolidation range. This is generally a good sign. And what we want to assess is the underlying fundamentals. Do we think that this particular rally has the legs to keep going? Is it a longer term bottom that's been established, or is this more a short term, just a local low before we actually have more downside pain ahead? So we're going to try and assess this in terms of the quality of the fundamentals on the supply dynamics basis, as well as some of the spending behavior that's been going on. Now, what we're also going to spend some time looking at is how this compares to previous cycles. We're going to use the realized cap HODL waves. We're going to use things like our URPD metric, and we're also going to close out on the on-chain cost basis. This is looking at the realized price for our short-term holders, long-term holders, and the market at large. So just before we get started, please do give us a share and a subscribe and a like. We really do appreciate you, watching our videos, and hope you continue to take new insights from it each week and just absorb a little bit more each time. On-chain analysis is quite a complex field, and it's that repetition of just seeing the same metrics, seeing things pop up here and there, and understanding how you can make connections between different metrics. So certainly it is a good process to go through. So hopefully you're enjoying it and learning something along the way. Let's get started. So here we are in our week 13 dashboard, and we can see we've now had 3 consecutive weeks of positive price action. This is a good sign. And you can see we've now broken above the previous consolidation range. So we are seeing constructive price action. And if we compare that to our accumulation trend score, we can see that we had a large amount of accumulation in the first leg of this correction, which we've already talked about. These are most likely those price insensitive hodlers. However, as we're about to explore, even some of these folks who have hung on to their coins for some time have been part of the spending pattern. So you can see that there was a lot of accumulation through this process, but as you can expect, those folks are also the most likely to redistribute because they've just bought the top and they're therefore going to distribute. So we'll see some of that playing out. But what we can see is that we've seen this kind of off and on, hot, cold, but generally more accumulation than not going on through this consolidation range. And note how we also have quite strong signals right now. We're getting up to values of 0.6, 0.77, 0.9. These are getting much closer to 1. So it's showing that overall the market is in net accumulation, and it's a very constructive sign to see. And what we really want to see is, does this persist for a longer period of time? Do we see any kind of new macro or geopolitical risks that shakes this overall accumulation? Or do we actually see the market continues to provide that support and that bid side on the way up? Now, to open up, what we want to look at is the URPD metric. This stands for the UTXO Realized Price Distribution. Now, some of you may be familiar with a similar tool from technical analysis called the volume profile. It's essentially looking at where has all the volume been transacted at different price levels. Now, what we're looking at here is on an entity adjusted basis. So we've removed things like miners, self-shuffling, we've removed exchange internal transfers. It's a really clean data set when we do our entity adjustment. And what we're looking at here is where essentially is the realized price or the cost basis, the price of acquisition for all of the coins within the coin supply. Now I've got 2 variants here. The one on the right is our standard URPD metric, and this one just shows across the board where are all of the Bitcoins priced based on when they last moved. And we can see that there's a very, very large cluster sitting here between about 38,000 up to 45,000, which has essentially been the consolidation range that we've just been in. We can also see that we still have a modest volume cluster above, although it has thinned out over recent weeks. We talked about this about 3 or 4 weeks ago, where this was showing very little distribution, especially compared to the previous period when we were in May, June, July last year. So we've still seen some redistribution. These are people who bought the $60,000 top and then panic sold or sold to get their money back as much as they could as we got down to lower prices. But we can see how much this has filled out. This shows that there has been accumulation. People have stepped in to actually buy those coins. So it's a signal of support and demand. And the way to think about this is that the market generally perceives the $38,000 to the $45,000 level. Some people were sellers, but it also means that people saw that as a value zone because for every seller, there's a buyer by definition. So we've seen a redistribution of coin supply to a lower cost basis, which is generally a constructive sign. Now, the second variant, this is actually an unreleased metric so far. This is one from the Glassnode engine room, and this is breaking down this same volume profile, but in the red, we have our short-term holders. In the blue, we have our long-term holders. Remember that they're coins that are older than 155 days and statistically the least likely to spend, whereas short-term holders are the other side of that equation. They are the most likely to spend because they most recently purchased. And then we also have our exchanges. So we've actually isolated those out into those gray bars. And really what we want to look at here is the blue and the red zones. That's the most important for our current analysis. Now, what we can see is that we still have a reasonable amount of these long-term holders. Now, just for reference, 5 months ago, we were somewhere in the October-November all-time high. So one way to think about it is that most long-term holders purchased before the all-time high, and most short-term holders are those who purchased after the all-time high. So that's the kind of realm that we're in terms of the overall distribution of holders. So with that in mind, note that these long-term holders essentially bought on the way up because we've got prices at 50,000. There's going to be some who purchased back in 2021, but a lot of those actually redistributed lower. So we saw a large redistribution of coins in that May, June, July period. So a lot of these long-term holders actually bought on the August, September through to October rally. Now we can still see there are some short-term holders. These red bars up here at the $60,000 level, by definition, they must be up in this zone. This is really the short-term holders who are currently at a loss, but you can see that most of them have more or less redistributed or become long-term holders. So overall, it's showing that most of the spending that was probably going to happen appears to have happened down here. And we can see how much larger the short-term holder cohort. Look how big this is. The only way that these red zones could possibly happen is by people who literally accumulated down the bottom. Now remember, the accumulation is a two-sided equation. Somebody had to sell the coin and somebody had to buy it. So there was sell-side pressure, which is why we get these declining prices. And it's why we can see accumulation happening at the same time as prices heading lower. These supply dynamics take time to play out. And really, it's a process that markets go through of redistributing coins. It can be within the same price range. We traded sideways, but the ownership structure of Bitcoin has now changed. There's new people who have come into the market, accumulated coins for people who were exiting, many of which would have been at a loss. So we have seen this kind of readjustment or a reshuffling of the coin supply, and overall seeing a large cluster in this $38,000 to $45,000 realm is a good sign. It shows that people saw value down at those prices. Now, what we can then do is look at a couple of metrics which are a bit more big picture and then move it from the supply dynamics realm into the spending realm. So we're looking at this kind of supply dynamics are typically very long term. We're looking at who owns what, how old the coins are, and how much volume is in each of those different cohorts. And then we look at the spending, which is a more immediate term. Are we seeing those older coins coming back into sale? Are people losing conviction, or is it generally fairly constructive? So what we have here is the percent of supply last active 1 year ago. So in terms of a very, very big and long-term picture, this metric is very, very cyclical. You can see that we get distribution. This is coins being spent out of that 1-year-old band through the bull market. It typically slows down through the bear as more people start to reaccumulate. The spending typically slows down. And then after a year, we start to see a large climb. Now, remember that this particular metric climbing at this rate, this is very significant, and it's almost at all-time high. This is the existing all-time high, about 63.5% of the total supply being older than 1 year. And here we are testing about 62.8%. So it's getting very, very close. And really what this signals is that 1 year ago, and we're at the back end of March now, so that's really showing the amount of coin supply that was accumulated in Q1 2021 on the way up. So we can see that a very, very large amount of that supply remains unspent, but also it has the possibility to start slowing down. Now, it might start slowing down because remember, as we come into April and then into May, we're in this topping pattern where we know that lots of people who purchased up here distributed over the coming months after we had our 50% correction. So I would not be surprised if this metric actually starts to slow down a little bit. And that's not the worst thing. It's just we're understanding why the data and why the metrics are doing what they're doing. So it's telling us that we do have a large influx of coins that are now 1 year old. We can have an expectation that that will slow down. What we really want to look for is, does that start to accelerate again? And the next time we can really think about that accelerating is probably as we come into June or July this year, because that's where a lot of accumulation took place at this previous bottom. So we'll wait and see. Let's see how that plays out. That's just one to kind of have on the radar for the coming future. Now, as a result of the 1 year old supply climbing so heavily, our realized cap HODL ratio, the RHODL ratio, is currently in a massive decline. So we have to understand what goes into the RHODL ratio first. It's a ratio between the 1 week old coins and the 1 year old coins in terms of their realized value. So the way to think about this, if a coin is 1 week old, it's been recently accumulated. And when we have lots of coins that are 1 week old, it generally signals that we're probably closer to a top because lots of old hands, 1 year old plus coins, have spent and new hands have come in and purchased those. So it's been a redistribution of ownership from the strong to the weak, which is generally what a market top looks like. Now, as we see the opposite of that happen, where more coins move into the 1 year old band, these are the longer term investors, people who have longer time horizons, the stronger hands, we will see this metric decline. So this metric is falling as a result of this 1 year old coins rising because the denominator is getting larger, which means that this metric will decline. So the other way to think about this metric, it's kind of like a reset. It's a reset of the structure of who holds Bitcoin. We're seeing a larger proportion of the supply and the wealth held in Bitcoin owned by these older hands. It's a good sign. And we can compare this to our reserve risk, which is another one of these big picture long-term oscillators. And we can see that we've had our phase of net spending. When this metric rallies, it's showing that price is rallying and the long-term holders, people who have older coins, are selling into that strength. Now, conversely, when we move back into a regime of hodling and there's more of the demand to actually hold the asset, reserve risk will get pulled lower and lower and lower. And we can see that back in July, we came down to a low point, we rallied, but note how even though price is actually higher than we were back in July, this was 29,000, and here we are up at 47,000, note how reserve risk is actually in the green zone. So the reason this is you can think about hodling behavior in reserve risk like a big anchor. The more hodling that's going on, the more it's going to pull down reserve risk. It's going to haul it down into that green zone. And we can see that even during the first phase of this bull market, it stayed within that zone because there was still hodling going on following the March 2020 event. So reserve risk is a very, very reflexive metric. It's very, very slow on the downside. It takes a long time to signal that a bottom is actually in, but it does show that when we have lots and lots of accumulation and hodling going on, this metric will get hauled lower. Now, conversely, when we get towards tops, this starts to accelerate very, very quickly. This is on a log scale, so it really does scream to the top as we get price moving up and we get long-term holders spending. So it's reflexive to the upside and very, very slow moving to the downside, but it does give us a bit of time to kind of assess when those bottoms are forming. So now let's think a little bit more about the spending behavior. We know that long-term holders are typically we want to see more hodling going on. We want to see less spending and more hanging onto their coins. Now, we've had two 50% plus drawdowns over the last 12 months, which is pretty brutal. It's been, we haven't had exactly the 85% correction that we've got in the historic Bitcoin bears, but instead we got a double whammy of two 50% drawdowns. And again, this has been a long process. It's been over a year that we've been in this macro consolidation, and it can test people's patience. So as we start to rally out the top of this realm, what we're seeing, this is our supply last active or revived supply. So whereas this is the amount of supply held that is inside that 1 year old band, this is showing how many BTC are being spent from out of that band. So we can see how this is starting to slow down just a little bit. Let's zoom in just a bit. We can see that we've got a little dip here. That's as a result of this spike in 1 year old coins coming back to life. And we can see that this is somewhere around 10,000 BTC. We got somewhere up, this is about 17,000 BTC on a single day. So remember that as we rally north from here, we are going to see some people who want to de-risk. They may want to take exit liquidity. They may want to use the market strength to actually hedge their positions a little bit. We are seeing a little bit of spending going on by this older cohort. So it's just something to bear in mind that it's not going to be smooth sailing. There is going to be some spending that happens. Typically after these long periods of time, people become impatient. They fear what may be coming down the road. So we are not out of the woods yet. And we do need to pay attention to this spending behavior as the market tries to recover. Now, on that note, there's a couple of tools that we can use here to really understand this. The first one is our profit and loss return meds. This is another one of these metrics from the Glassnode engine room. And what we're looking at here is only coins that are flowing into exchanges, because the assumption is that they're the most likely ones to be sold. So we're trying to really characterize our sell pressure, specifically looking at the amount of profit and loss they're in. And we can see these large capitulation events that we had in 2018 at the start of the bear, 2018 at the very end of the bear, March 2020, our miniature capitulation by this scale. Remember that these are very, very large capitulations. It shows a large amount of the coin supply remains hodled through this bear. This has been a very interesting bear market. We haven't seen the same kind of net expulsion of coins that we've seen in previous cycles. And a big reason for this is actually because of derivatives. So the same way that a buy side on a perpetual future may limit spot on the bull market, we actually also see that people can hedge their risk rather than selling spot, because back in 2017, really the only way to hedge your risk was to sell spot. Whereas now people can use options or futures. They can use these instruments to hedge their risk without necessarily selling the spot. So we see these interesting dynamics evolving over time. Nevertheless, we can see that we've seen a significant amount of losses in both the May to July period and then again recently. So whilst they're not at the same scale as what we saw back here in March 2020 or in 2018, they are still notable on the chart. We have seen an expulsion of users who are essentially bought the top and are now selling at the lows. So we have seen this kind of general exhaustion of sellers over time, and yet the market was able to provide that floor. And at the same time, we are seeing net outflows from exchanges. So it's generally reasonably constructive. We're still seeing that net outflow, and we're not seeing anything like what we saw back here in May, which was a significant period of about 2 or 3 months of net inflows. So overall, it's relatively constructive by comparison, especially compared to the May to July period. Now, the next tool is the spent volume age bands. I'm actually going to jump across to the full scale chart here. And what we're looking at, this is similar to the revived supply, but what I've filtered for is all the coins that are older than 3 months. And again, you can tune this to whatever particular cohort you want to be looking at by turning off and on the legend items. But we can see that as we started to gain some strength over the last couple of weeks, we've seen a net growth in these older coins being spent. So let's just think about what's going on here. We do have a rally off the bottom. We've had bottom formation and accumulation that looks quite constructive, but we're now getting some market strength. There's now enough bid side to push the price higher, and we're seeing a general growth in the amount of older coins coming back to life and that spending behavior. So it really signals that we're not necessarily out of the woods yet. However, the flip side to it, let's imagine that price continues to rally. It's showing that even though the sell side is happening, the market continues to be able to push through it, which again is signaling that strong demand. So it's really important to remember that for every seller, there's a buyer, and vice versa. So if we do get market price moving alongside lots of spending, it's actually telling us that there's quite a bit of underlying demand supporting the rally. Conversely, if we see a reduction in our spent volume age bands, which we can see through this period here, if we see a reduction in our spent volume age bands of older coins, that means that there's less spending going on, but the market still couldn't find support. So that's actually a more bearish observation. Because it's spending less, there's less sell side, but at the same time, the market still can't absorb it. So we could use these in combination to understand what price is doing and compare it to what the on-chain metrics are doing as a bit of a gauge for both supply and demand. You need one and not the other, right? So they both work in tandem. So the last metric that I want to close on is the realized prices. Now, this is what we generally consider to be the on-chain cost basis. Let's look at all of the coins in the supply break them down into short-term holder, long-term holder, and everybody, and compare them in terms of what is the price when, on average, that those coins last moved. So most of you should be familiar with the orange curve, which is our standard realized price. It looks at every coin in the entire supply and it maps it out in terms of an overall cost basis. And what we can see is that we've been trading somewhat higher than that, which again, in previous bear markets, we've come down and revisited this level, which is quite interesting. It's showing that perhaps there's a greater propensity for people to actually be hodling Bitcoin, which kind of describes why we didn't get the 85%, well, not yet anyway, the 85% drawdown, we had to 50% instead. So again, we don't know what the future holds, but so far it's actually showing a relative level of strength. We haven't come back down and tested the overall cost basis in the realized price, which is trading down here at about 24,200. Now we can see that the long-term holder realized price in blue, this is a much slower moving. It typically moves 5 months after the realized price because that's when people are becoming long-term holders and coins are moving into their age bracket. We can see that we've actually got this starting to decline, and it's actually declining at a very significant rate. Now, this decline can only come from one place. The long-term holders who bought on the way up during this rally, selling at a loss. That's essentially what we're seeing, and that as a result, when these long-term holders sell, the cost basis, because imagine you have someone with a cost basis of 60,000 and someone else with a cost basis of 30,000. Well, if the guy with a $60,000 cost basis spends and is no longer part of the long-term holder cohort, the only cost basis that's left is the guy down there at 30,000. So by the decline in the realized price for long-term holders, what we're actually seeing is that long-term holders who bought the top are exiting, and that's leaving only long-term holders that have a large amount of, a lower cost basis left in the cohort. So it's actually showing that we're getting that expulsion of long-term holders who were going to sell, which feels a little bit like a capitulation event. Those long-term holders who bought the top are being net exited from the system, and all we have left are those who have hodled through multiple ups, multiple downs, and have a lower cost basis, and also are therefore less likely to sell because they're currently in profit. Now, the last one I want to close on is actually the more interesting one. Let's zoom in here on the 1 year so we can really see what's going on. And that is the short-term holder cost basis. Now, this particular metric, maybe I zoomed in too quickly. Let's go back to the 5 year just quickly, and I will turn off these other two for clarity. Now, the short-term holder cost basis is much more reactive. It moves because short-term holders are kind of that churn at the front face, right? They are spending all the time in and out. They're traders. They're people who are just entering. They're panic selling. They're buying. It's the marginal buyer or seller. And we can see that we typically get support in bull markets all the way up. Conversely, we get resistance in bear markets as people sell just to get their money back. I just want to get my money back. It's kind of that logical idea that people just want to exit at any cost. You can see that it typically follows price, but provides that support and resistance, and typically describes when we're underneath it, it's more bearish. When we're above it, it is more bullish. We can see the same through 2020, and then we fell below in that May, June, July period. So we've been underneath the short-term holder realized price for some time, really since early December, when we had that 4th of December flush out. And what we can see is that we are in the process, or have now broken above it at 46,400. So really, let's keep that in mind. It would be very, very important if we came back, if we retested it, if we managed to hold above the short-term holder cost basis. The probabilities that this rally actually has some legs further to the upside would be increased. And we can combine this with many other things, looking at the 200-day moving average or other metrics that kind of signal we have a confluence of strength in the market. So far, this is a good sign. Let's be cautious and just wait and see whether this spending is able to put too much resistance in. Do we fall back below that 46,400 level? That's a key level that I'm certainly paying attention to. We may come back and retest it a few times, but what we really want to see is a nice strength that kind of carries the market up and above from that. So thanks for tuning in for this week. Hopefully that provides a bit of context as to what we're looking at, the underlying fundamentals of this particular rally. It does look like we had that accumulation happening, and we're now starting to see the result. What's now really important is we want to pay attention to the spending behavior. Do we see the market continue to rally and push through, or do we actually start to see it losing some of that momentum and strength as a result of the sell side? So we're trying to assess what the strength of this rally. It looks good from the fundamentals underneath, but we really need to assess the kind of headwinds as we move forward from there. Thanks as always for tuning in, and I look forward to seeing you in Friday's video. Cheers.